The Federal Reserve reports on industrial production in the United States of America. And, well, it's very interesting. Do they go to every factory gate, knock on the door, and say, "Hello, my name's Jerome Powell. How is your activity this month?" and then report back to the statisticians? No, they don't. No, they don't. I guess that's it. And that's the end of the show. All right, Jeff. Jeff Snider, head of research at Alhambra Investments. Jeff, they don't do that. They do an estimate, but then eventually they get a better estimate. Tell us, how do they collect this data? And then the data revision is, wow, what a revelation. We're going to get to that. But first, how do they get this data?
Yeah, almost all economic accounts are done by sampling, because it's just, I mean, you can't go to every business in the economy and say, especially on a monthly basis, and say, what was your level of activity this month compared to last month or last year? So they pick out a panel, a survey panel, and they call on these people regularly, and they use them as the basis for coming up with monthly high-frequency estimates for how things are progressing. And then usually every year, they go back with a much larger sample to check their work, so to speak, to say, okay, the high frequency data using a smaller sample, were we close? Were we there? Did we get it right? I mean, how far off were we? Because a much larger sample, you have more high degree of confidence and accuracy. And that's usually what these benchmark revisions are about. It's when whatever government agency or data collection agency goes back and uses a much larger sample on a much more infrequent basis to benchmark where the data is in relation to where it should be given the much greater sample. The Federal Reserve is, of course, with their industrial production numbers, they do exactly the same things.
The article that we're reviewing is called Yields, Not Dots. Another example of why inflation had no chance. And that was posted on the 16th of June at Alhambra Investments. Well, one of the statistical, and you said it, Jeff, you put the word tricks in quotes. One of the few statistical tricks that they use to help themselves is something called trend cycle. Is that one of those new Peloton bikes that I've been hearing about, Jeff?
The ones that are recalled because they're killing children or something, I don't know. No,
well, we can write off that sponsorship, Jeff. Thanks a lot.
Yeah, I think so. So trend cycle is nothing more than a subjective assumption that's incorporated into high-frequency data, and not just industrial production, but a number of high-frequency data accounts, simply because economists need to have some way of sort of centering where their estimates go for any month-to-month changes. So what they assume is that, look, if we're in a recession, then regardless of whatever the panel sample tells us, it's likely to be a downward progressing baseline. And so we'll mark our monthly changes based on a downward sloping baseline or background. And of course, the benchmark revisions come along and say, yes, that was a good idea or that wasn't a good idea. And consequently, if you think you're in a growth period, you would chain all of these monthly progressions to an upward sloping baseline. But again, you're assuming that with trend cycle, that the trend in cycle is going to match all prior trends in cycles, because that's really what you're using to formulate this subjective assumption about how to chain together these monthly changes in whatever underlying data. So trend cycle becomes sort of a subjective component where you're already sort of assuming that, yes, because we're not in recession, it must be in a growth period that looks like other growth periods. And that can lead you into all sorts of trouble.
Jeff, I think the punchline of this show, where we're heading is that the statisticians in charge of this trend cycle don't watch this show.
No, and they don't watch the show, nor do they pay attention to the bond market, which I think is our overriding thing here, is that, look, you know, when we go back to, 2017, 2018, and those years, what we saw was, hey, bond market is saying things are not going as well as we think they are. Number one, 2017, globally synchronized growth isn't all growth. It's global and synchronized, sure, but isn't necessarily growth. And then 2018, we're seeing all sorts of stuff go haywire. And then what we call the landmine, which showed up in October 2018, which was the market essentially saying, this thing is already going wrong. So while Jay Powell and the Fed was still talking about inflation and rate hike, in fact, they did 2 more rate hikes right up until December of 2018. The bond market was saying, no, 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 no. This economy is already in reverse. Things are going badly. And using, you will use the Fed's industrial production numbers here, as you just had.
I'm sorry to interrupt, but there's the graph. There's the bond yields all of a sudden doing a 180, heading the other direction, while the central bank, the academics, they kept raising rates because according to their models, the economy was improving. And then you could see the yields just slicing through that policy range.
Even before October, you could see how the curves flattened out, and that's the Eurodollar Futures curve.
Right.
How the curves flattened out and inverted in Eurodollar Futures, which even before we got to the landmine was a serious warning that, hey, the hidden participants in the monetary system that are very close to the actual conditions in the real economy because they operate in the real economy, they're telling you what's going on. Yeah, you can have all the data you want. You can use FERBIS and other DSGE models, but this is the system from the inside. This is the economy from the inside telling you what's going on in real time, pricing out in markets. And what we saw was that even before the landmine, these participants deep down in the real close to the real economy were saying, things are not going well. And then as we got to October in the landmine, what they said was, things are not just not going well. Now they're really, really not going well. In fact, things are going the wrong way. Well, that was the economy trying to tell you that something is already wrong here.
Well, you can't blame the central banks, Jeff, because the markets don't have PhDs. So, did the market go to Yale or some Ivy League school or Oxford? No, Jeff. So let's not be too hard on our monetary technocrats. Okay, so now we're looking at industrial production, and we have several lines on here, and they represent revisions. Jeff, I see...
These are the various annual benchmark revisions. And so the series that are based on those benchmark revisions, what you see, the dotted, the dashed blue line, which is the previous benchmark before the one that was just released this week, what it shows is sort of like what the mainstream narrative had been, which was that it looked like the economy was progressing relatively fine up until December. Maybe it had slowed down a little bit in the middle of 2018, but still largely healthy and moving forward, consistent with Jay Powell's idea of rate hikes. Now, that was just data, though. That wasn't the real economy. The real economy was something else. Again, the bond market was saying, I don't care about your IP samples and your benchmarks and all your data and things like that. In the real economy, you're not measuring it properly. Things really are going in the wrong direction. Of course, now we get the benchmark revisions for the 2021, which were delayed. We didn't get any benchmarks last year because of COVID. But the benchmark revision of 2021, the Fed finally says, oh, our bad. You guys were right. The economy really wasn't good in 2018. In fact, when it hit the landmine, it was already reversing. So yes, the bond market absolutely nailed it when it said that the real economy in reality was very different than what Jay Powell was saying, what the data was saying at that time, which was things were that the conditions, the economy growth and everything else was still moving forward. When in fact we see now, after all these later benchmarks, no, not only that, not only had the economy already started to reverse in 2018, late 2018, we also see that the year before, 2017, globally synchronized growth, supposedly the basis for this inflationary rescue and everything else, yeah, that wasn't as good either. So not only did the bond market get the 2018 part absolutely perfectly right, it also got 2017 correct too when it said, no, we're not seeing a lot of growth in this globally synchronized crap. It's really kind of underwhelming. In fact, it's suspiciously underwhelming. So it doesn't matter what the data said at the time. The data was faulty. And it's only later, years later, do we see that the data gets corrected and shows that, yeah, maybe we should have been paying attention to the bond market and bond yields all the time because they got it completely correct.
Jeff, not only did the bond market get 2017 right, 2018 correct, but I'm worried. I'm looking at the post-2020 revision. That looks really bad. What that's telling me
That
is
might be even the worst part, right?
There was, yeah, that's right, Jeff. Real time, right now, the latest revision, just looking back a year, says we are much worse off than we thought, which corresponds to what the bond market has been saying.
Yeah, low yields, right?
Yes.
Yields that remain stubbornly low. And guess what? Here we see in the revisions where at least industrial production, it's not just industrial production, but a whole lot of data. It says, hey, look, this rebound from the recession last year has been a whole lot less robust than we thought before. And it wasn't that great to begin with what we thought before. This last benchmark revision showed maybe the bond market has a point here. So not only did it get 2017 right with low the way the yield curve was behaving in 2017, it also seems to have gotten 2018 completely on the nose. And maybe, by the way, all those people rushing to dismiss low bond yields in 2021 might want to rethink that strategy, because time and again what we're seeing is those are the participants in the monetary, deep in the monetary system, right next to the real economy, doing real transactions with the real economy, telling you in price behavior, inscrutable or irrefutable price behavior that says this is what's going on. And if long-term interest rates aren't rising, then it's a pretty solid signal that you're not seeing the growth and inflation and all this other stuff that supposedly would come about if this money printing stuff the Federal Reserve did actually worked. The bond market is telling you, and now the data, which has been faulty up to this point, is also agreeing. And here's the worst part here. The benchmark revision that just happened, well, that's just the benchmark revision what just happened. Given the way bond yields are, and as you always point out, Emil, this reflationary period is the worst one by far. Would we really be surprised if 3 years down the road further, at 3 more benchmark revisions, the Fed says, oh, by the way, the rebound that already got written down, we're going to write it down even more. We're going to say that the economy's rebound from 2020 was even less than we thought it was. We wouldn't be surprised, number one, because that's the history of these kinds of things. And it wasn't just 2017 and 2018. The Fed and all these other data agencies had the same problem in 2014 and 2015. And they're probably going to be the same thing again, especially as bond yields remain so incredibly low that they're telling you that things really aren't that good. And so again, would we really be surprised if 3 years down the road? But that's kind of the point too, is that here we are 3 years later, and sorry, we got it wrong. Our data was faulty. Guess what? Jay Powell's ridiculous story about inflation recovery, that was never really happening in the first place. That seems kind of important to have known at the time and not just 3 years later.
And even though this is the first time we've discussed data revisions on this show for 15 months, as you mentioned in 2014, you've been writing about this for a while, and we see that consistently.
Yeah, this is one of those things that really, it kind of makes me mad. Because you say it's, by now, nobody cares about 2017 and 2018, right? Who cares? We've got our own problems but this is really important because it shows you. Listen to the bond market. It's got its fingers on the pulse of the real economy because that's what it does. Stop listening to these other people. Even the data is faulty, especially in these reflationary periods, especially given trend cycle bias, which tends to overstate them anyway. And it's so frustrating because only years later, when nobody cares and nobody pays attention, do they come back and say, oh, we got it wrong. Sorry about that. Everybody who was thinking Jay Powell and his rate hikes were the right thing to do, no big deal. We just completely missed out on it. It's completely frustrating.
Thankfully, we have the mainstream media, Jeff Snider, to ask these questions at these press conferences. So don't worry. Well, maybe you are worried because another article that you wrote something similar on was titled More Than a Benchmark Peeve. It's more than a pet peeve. It upsets you, Jeff. And people may be saying, well, okay.
I think you agree. This should upset everybody, right? This should be one of those things where you say, look, you guys, your data is faulty, and then it's not like you make a big deal coming clean. It's sort of buried in the benchmark revisions that come out with regular monthly reports anyway. And it's not like the mainstream media. I've never, ever seen a mainstream media article on benchmark revisions. So it's not like it's widely publicized. And I would imagine that 99.9999999% of the public has never even heard of benchmark revisions, let alone the gravity that's contained within, especially these reflationary revisions that end up completely rewriting economic history, because actual economic history turned out to have been very, very different all along. And it was the same economic history that the bond market was pricing in real time. So as people are very quick to dismiss the behavior and yields and Eurodollar futures and dollars and all these other things, maybe you need to think again. And if you don't know about these benchmark revisions, maybe you don't have the same reasoning for thinking that way. But when you look at the benchmark revisions, and as I think you're trying to pull up here, it's not just industrial production, it's a whole range of data, including retail sales, that says yes, the economic picture during these reflationary periods doesn't match up with what mainstream policy, whatever expectations or narratives at the time say. By and large, there's usually a very different underlying case in the real economy, and the data is not suited, the high frequency data is not suited to capturing these problems.
May 14th, when you published this article, More Than a Benchmark Peeve, I tweeted about it and I said this is one of the most underrated aspects that I don't hear anyone else talking about during this downturn, this silent depression, these revisions. It's a scandal. It's quite important. Like I said, it's just very important, yet underrated, underreported. And as you said, retail sales. So people may say industrial production. How quaint, how 1950s. What do we care? It's a consumer economy. Guess what? Same story, retail sales. Jeff, is there anything to say other than looking at this graph that we see retail sales being revised down when more comprehensive data is at hand?
Yeah, it's the same picture, which is, it's not like economists or the statisticians that the government set out to mislead the public. That's not what's going on. It's just that the way that they construct these statistics are ill-suited, and they've been shown repeatedly to be ill-suited to this post-crisis era. Because, number one, I think trend cycle is leading them in the wrong direction because these trends are nothing like prior cycles. And number two is that, look, I think there's an enormous amount of difficulty in parsing these different levels of changes, which, going back to our overall theme here, maybe they should be paying attention to the bond market. Maybe the statisticians should be getting their trend cycle assumptions from the behavior of yields and Eurodollar futures and things like that, because time and time again we see that the yields have their pulse on the actual economy. Whether or not the data at the time shows it, we're reasonably assured that the data in the future will go back and rewrite history that's even closer to the bond market's view contemporarily.
Jeff, if we haven't covered something that you want to, let us know. Otherwise, I'll tell the audience that today's show was sponsored by David Parkin's Illustrations and your upcoming appearance on the 23rd of June, a Wednesday, if I remember correctly, at noon at Hedgeye, where you're going to be discussing, the topic is inflation tsunami. I can't wait to watch it.
Me neither.
They had Mr.
The inflation tsunami. I'm wondering, is that what I'm going to be talking about?
They had David Rosenberg on yesterday. And as I've told you on the show, he has also been saying transitory, not going to happen. But he came at it from a completely different angle, not the monetary angle. He came at it from an economic perspective. I haven't watched yesterday's show yet. I intend to. So if he's changed his mind 180, forgive me. But the two episodes where he appeared before, I saw him saying, no way, no way, no way. So it'll be very interesting. Next week, Wednesday, the 23rd. It'll be great. And it's free for everyone that wants to watch it. Jeff, any final words?
Hedgeye TV.
Yeah, great. Well, I was going to say second best, but then I think there are all these great shows, George Gammon, Nick Black. My God, there's so many good shows out there. Never mind. It's a great program on Hedgeye. Jeff, anything that we didn't cover that you wanted to say?
No, I think just wrapping this up, our theme this week for these episodes or these parts of the episodes is people want to dismiss bond yields and low bond yields because they don't like what they're saying. But history has shown time and time and time again, even data has shown, don't do it. Don't dismiss low yields, because the low yield, at least the people who are producing low yields, are telling you what's going on in real time. And if you're thinking that, oh, it's some artificial, we can just, it's our star, it's bond buying, it's whatever. No, history has been very clear on this subject. Follow the bond market, not economists.
That ding-a-ling-a-ling sound that you just heard, Jeff, was not my publicist messaging me on my phone, but me realizing what I'm going to ask David to draw. I'm thinking of a Zeus-like figure. Beautiful, beautiful. David, like the sculpture, Zeus. And he's standing on a mountain, and somewhere it says bond market. And then you see some guys and ladies at the bottom somewhere, and they go, his shoelace is untied. I don't know. We're not going to follow that guy. Anyways, that was the
it's a logic. It's almost a logical fallacy. If you don't like something about some little tiny thing, we'll just dismiss the entire message, right? And it's completely mistaken, because this is information. It's really good information. It's probably the most pristine information. And that's really the point with our last segment here is, even this economic data, which, industrial production, for the Fed's industrial production, goes back 100 years.
Yeah.
This is the creme de la creme of economic data. But even it is not pristine. It is subject to all sorts of faults in the data. And these faults have become more frequent, especially during these reflationary periods. So bond market information, actual market discounting actual things as they take place, versus faulty data and even more faulty narratives about the faulty data, you can see where you really should be focused.
Thank you, Jeff. Talk to you soon.
All right, take care, Emil.